On Friday, September 12, 2008, America's most powerful financial leaders walked into a building in New York. By Monday morning, the global economy would never be the same. If they failed that weekend, millions of Americans might not access their money. In the early 2000s, home ownership was at record highs. Banks were offering no income, no job, no assets loans. House flipping culture took over. Between 2000 and 2006, US home prices rose nearly 90%. Banks weren't just giving loans, they were selling dreams. Subprime loans were packaged into mortgage-backed securities and CDOs. Credit rating agencies gave them their AA ratings. Wall Street wasn't holding the risk, they were packaging it, selling it, and profiting. Major players like Lehman Brothers, Bear Stearns, and AIG were all in. Some banks were leveraged 30 to 1. For every dollar they had, they borrowed 30. If assets dropped just 3%, they were insolvent. Housing prices started falling in 2006. Defaults rose. By 2007, Bear Stearns collapsed. Confidence started shaking. But leaders publicly said the subprime crisis was contained. It wasn't. The story doesn't end with Lehman Brothers filing for bankruptcy. In fact, that was just the beginning. On Monday, September 15, 2008, the world woke up to the news, and pure, unadulterated panic ripped through the global financial markets. The Dow Jones Industrial Average plummeted over 500 points, its worst single-day drop since the 9/11 attacks. It wasn't just Wall Street. Stock markets from London to Tokyo went into a nosedive. The intricate web of global finance was unraveling at an alarming speed. See, Lehman wasn't an isolated case. It was deeply connected to countless other banks, insurance companies, and investment funds. Its failure triggered a catastrophic chain reaction. The very next day, the crisis found its next victim. AIG, the American International Group. AIG was one of the world's largest insurance companies, and it had insured trillions of dollars worth of those risky mortgage-backed securities through something called credit default swaps. With the housing market in freefall, AIG was on the hook for massive payouts it simply couldn't afford. If AIG went down, it would take the entire global financial system with it. The US government, which had just let Lehman fail, now faced an impossible choice. They decided they had to step in. The Federal Reserve announced an $85 billion emergency loan to save AIG from collapse. It was a bailout of unprecedented scale, and it signaled just how deep the rot was. The government knew the AIG bailout was just a band-aid. A much bigger, more controversial plan was being drafted in Washington. It was called the Troubled Asset Relief Program, or TARP. The idea was for the US Treasury to buy up to $700 billion of toxic assets, those worthless mortgage securities, from the banks. The goal was to unclog the financial system and get credit flowing again. But when the plan was announced, the public reaction was furious. People saw it as a massive bailout for the very same Wall Street bankers who had caused the crisis, using taxpayer money. The outrage was deafening. Calls and emails flooded Congress. The initial TARP bill was actually voted down in the House of Representatives, causing another massive market crash. After intense political wrangling and a few tweaks, a revised version was finally passed and signed into law. The immediate crisis was averted, but the long-term damage was immense, especially for the American middle class. The Great Recession that followed was the worst economic downturn since the Great Depression. Millions lost their jobs, their homes, and their life savings. The wealth gap widened dramatically. While the stock market and corporate profits eventually recovered, many families never did. This led to years of soul-searching and heated debate. Was this a failure of a few greedy individuals, or was the entire system broken? In response, lawmakers passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. It was the most significant overhaul of financial regulation in decades, creating new agencies like the Consumer Financial Protection Bureau and imposing stricter rules on banks to prevent them from taking on too much risk. The debate continues to this day. Did the reforms go far enough? Could a crisis of this magnitude happen again? The 2008 collapse wasn't just a financial event. It was a societal earthquake that reshaped our economy, our politics, and our trust in the institutions that govern our lives. Its aftershocks are still being felt today. Thanks for watching, and if you found this insightful, please like and subscribe for more deep dives into the events that shape our world.